as we do the adjustment, remember, it is going to affect the computations that we had started yesterday. And I want us to look at the growth rate which we applied in this after earnings before interest, tax, depreciation, and amortization. You remember that part when you were building up our statement of profit or loss, the forecasted one. And under depreciation and amortization, let us all look at note number 3, Roman 3, because that's where our adjustments are starting to take effect. So let's look at that note. We were told depreciation and amortization to grow at the same rate as non-current assets. That is, it was initially 15%, but we've changed it to 10%. So let us make that change on our computations affecting depreciation and amortization and also affecting non-current assets. So let us go to computations, which we did. And because we had put this 15% on a separate column, when we change it from here, it will take effect and all these computations will change effectively on that depreciation and amortization. So let's come here. Sorry? Are you guys getting me? Am I audible?
Yes, I can hear you.
Yes, very clear.
Yeah, so I think that member there, check your connection. It's your connection that might be having an issue. So kindly change the 15% which we had put there, change it to 10. Someone has unmuted and forgotten to mute back, so it's bringing interference. That is Lois. All right, I've taken care of that. So we change from 15 to 10. So I will just edit it there because it will take effect. We had connected the cells. So if I change, you will see all my figures for amortization and depreciation have changed and reflecting the 10%. So kindly do the same on your end so that we also do the next adjustment. Again, according to the same note, it was affecting these non-current assets. They were also to grow at 15%, which now is 10%. Because we had also put 15% here on a separate column, let us go ahead and also edit it from 15 to 10. When I confirm, all these figures will also change because of the rate that has changed. So I will do that and you'll see the rates, the figures have changed, reflecting the 10% change. Good. So that is the first adjustment, and I hope you have also done the same on your end. Let's go and effect the next adjustment or correction which was done, and that is in note number 4, where we are told interest expense is at about 10% of previous year's long-term debt. Long-term debt. Initially, there was an additional wording there that was saying which will grow at 20%. I hope you remember that term, that part. It was long-term debt which will grow. And so according to the corrections, we have done away with that part of which will grow. So we are stopping at long-term debt. So let's go to the interest expense and make sure it is 10% of previous year's long-term debt, just like that. So we go to our interest expense and it is 10% of previous year's long-term debt. And I believe the rate still remains the same. And it is long-term debt, 10% of it. And you can see we referred in 2023, that is the interest in 2023, is 10% of long-term debt in 2022, because that is the previous period. And you can see we referred to 24,000, which is the correct figure, right? When we went to 2024, it is again 10% of the previous year's long-term debt. And we refer to this cell where we already have figures. But now that we've done away with the growth rate in the long-term debt because of the correction, we also do away with these other computations which we had put in, because now this is not applicable. I hope we are getting it. So we will just do away with the 20% adjustment which we had done because it is now corrected, and leave all this space blank like that. And as we leave it blank, make sure your interest computation will pick 10% of previous year's long-term debt. Let's just confirm that. You will see that 2024 interest is blank, 2025 interest will be blank, 26 and 27. And the reason why they're blank is because we still don't have the figures for long-term debt in 2023, 2024, 2025, all the way to 2027, right? So let us now see how will we get the values of the long-term debts up to the end, because it is until we have the values here that we will get the interest computations on them. We've already set our formula of interest. It will be 10% of that figure. The figure here is still blank all the way from 2023. So just leave it at that until we get the figures of long-term debt. It will change the interest rate. It will charge that interest accordingly. Then that will eventually even affect our retained profit carried forward. So let's move to the next note after making those adjustments. I just want to hope all of us have taken care of those corrections as we move forward. Now, the next note after note 4, we are done with it up to that point, and I hope we are all together. Let's move to note number 5. Note 5 was about dividend payout ratio and retention ratio. So about the retention, which is 60%, we used that information to compute our dividends. If retention is 60, our dividend, it means we are paying a dividend of 40%. That is the payout ratio. So that percentage of 40%, we had already used it. We used it when computing dividends to be paid from 2023, 24, all the way to 2027, which I believe all of us, understood what we did there. Now we go to the next part after the retention rate of 60%, and we were told any balancing figure in the forecast statement of financial position is long-term debt. Now, that tells us after we've done all the entries and computations necessary, this our statement of financial position will not balance. And it will not balance, and the balancing figure which we will need will be the figure to fill up this space of long-term debt. That is the interpretation. So that means long-term debt will come towards the end. It will come towards the end because it is the balancing figure for our statement of financial position. It will balance it out. So because of that, we just take care, we just note that part, that it will be the balancing figure, and leave the long-term debt part blank. Let's move to note numbers, Roman 6, note 3. Note 3, Roman 6, and take care of that adjustment. We were told current assets and current liabilities will grow at 10%. Current assets and current liabilities will grow at 10%. So let's come to current assets and current liabilities and subject them to 10% growth rate. That is very direct and simple. So where are current assets? Current assets are here. Current assets are here. Current assets are here. So what is the growth rate? They will grow at 10%. So I will come here and just put the 10% here. That is the growth rate. And we subject this figure of current assets in 2022. We grow it annually from 2023 all the way to 2027. That 10% there. How do we do it? The same usual way that we've done growth rates. Put an equal sign, open a bracket, 1 plus that growth rate, right? And because we expect the growth rate to remain constant for all the years, make sure you fully lock it like that. Then you close that bracket, multiply by the figure in 2022, which is 24,000, like that. That will give us current assets for 2023. And because we have locked that rate of 10%, that cell is a reference cell and it will remain constant, we will be able to autofill for the rest of the years and it will take effect. So I will confirm, Control Enter like that, and I have 26,400 as the value of current assets in 2023. After I have that, then I will just autofill it to 2027 like that. I hope we are together there. I hope we are together up to that point. So those are the figures of current assets. Then it is current assets and current liabilities according to Roman 6. So let's also do the same for current liabilities. Good. So current liabilities, where current liabilities are here. So in the current liabilities section, we also apply the 10% growth rate. So I will just write that 10% like that. Then we do the same. What we've done in current assets, we do the same to current liabilities. Equal sign, open bracket, 1 plus, refer to where that your growth rate is. And because it is expected to remain constant throughout the years, make sure you fully lock it like that. Close bracket, multiply it by the figure in 2022, which is 20,000. So I will refer to that. Then I confirm by Control Enter. I have my current liabilities for 2023. And because I've set that formula and locked my rate, I'm free to drag it to 2027 like that. And it will all autofill like that. So that takes care of note 3, Roman number 6, like that. So we have taken care of all the adjustments in note 3. The only thing remaining in the whole of that note 3 is the part of long-term debt being the balancing figure. That's the only thing we will come back to check. But all the other things we've taken care of. I hope we are together. Let's move to note 4. Are we together to move to note 4? Are we all there? Confirm. Are we all there before we move to note 4? Guys, confirm if we are all together. All right. So good. If we are all together, then let's move. Let's move to the next thing. Now, note number 4 is telling us what? It's telling us the applicable weighted average cost of capital is 18%. Now, in these computations and as we build the forecasted statement of profit or loss and the forecasted statement of financial position, that note number 4 of the weighted average cost of capital has very little role to play, and it doesn't affect any of our computations at this level. We will use it, but not now. So we just note it, that note 4, we just note it that the discount rate is 18%. Let's look at note 5. Assume that the free cash flows to the firm for N Limited will grow at 3%. At 3% from the year 2028. It will grow at 3% from the year 2028. So that one also do not affect our forecasted statement of profit or loss that we've come up with and our statement of financial position. So those two notes, note 4 and note 5, will come in later when we are now narrowing down to the free cash flows. But now as we come up with this model financial statements, it does not affect. So what do? Very simple. Let's get to see how we will get the balancing figure which now represents the long-term debt, so that we finish up all these statements. We move to the next level because look at the required. Remember, our objective is to do valuation of this company to determine the value of N Limited using free cash flows to the firm. So that is our objective, doing valuation of this company. And as we do the valuation of the company, we first come up with the model financial statements, following the adjustments which we have just done. After having the model financial statements, then we narrow down to the cash flows. We now follow the cash flows. Remember, all these statements of profit or loss, statement of profit or loss is prepared on accrual basis. That means expenses are charged when they are incurred, but not when money is paid. Incomes are recognized when they, when there is a guarantee of receipt, when you've already, there is a guarantee of receiving the revenue, but not actually when cash is received. So we will narrow down and look at the cash flows to the next step as we do the valuation. Okay, so user, that is what we are moving to. We are looking at those other elements that we've not adjusted. So worry not. Now, I want us to look at the statement of financial position. The first element was non-current assets. We already have the figures. Current assets, we also already have the figures. Now that we have everything we need for total assets, so we just autofill the formula for total assets. And as I confirm the formula in 2022, it is just the total of the two. So I will just extend my formula and I will have all the figures of total assets. Total assets are there. Total assets are all there. So that's one adjustment. We are just doing formatting anyway. Everything we already have. So we go to the next stage, that is under equity and liabilities. So under equity and liabilities, I can see ordinary share capital. Now, did the examiner tell us anything about ordinary share capital? We've gone through all the notes and I was not able to see anything affecting ordinary share capital. Note 1 only gave us the number of shares and the market price per share. Note 2 gave us the value of the debt, the current market value of the debt, which was 24 million. And note 3, there is no mention of any factors affecting share capital. There was no new issue. We know the factors affecting share capital. If there is a fresh issue of shares, if there is a conversion of any debt element or debt instrument into ordinary shares, it will affect share capital. If there is any bonus issue, it will affect ordinary share capital. So whether there is a conversion, rights issue, bonus issue, we've not been told, or any new issue of shares. There is no mention of that. So that means ordinary share capital remains constant across the period. So we maintain the 16,000 across the years to 2027 like that. I hope we are together. Let us look at the next element of equity, which is retained earnings. Now, when we look at retained earnings, we know the elements that affect retained earnings. We know that retained earnings is affected by the retained earnings carried forward from the statement of profit or loss, which is above. So how do we make those adjustments so that we have our figures for retained earnings, the amount transferred from the statement of profit or loss to the statement of financial position? We know when doing published accounts, you normally know very well that the element or the retained profit carried forward from the statement of profit or loss, you normally transfer to the statement of changes in equity, and then from there, you effect any change, any factors affecting those elements. If there was an issue of shares at a premium and also at par, it will affect share premium and it will also affect ordinary share capital. Then if there are any transfers, for example, from retained earnings to general reserve, or you are told to transfer from maybe share premium or revaluation reserve account, those adjustments normally happen in the statement of changes in equity. But because we do not have statement of changes in equity, we will just work with the retained profit carried forward. I want you to look at 2022. Retained profit carried forward in our statement of profit or loss is what is reflecting under retained earnings. That is what is transferred to retained earnings. There are no any other adjustments done to it because we do not have those adjustments taking effect here. So the same way, we will come to 2023, then refer, put an equal sign and refer to the retained profit carried forward in 2023. That is what you transfer to the retained earnings in the statement of financial position. That's what we do. So I bring it there. And because I've done reference to 2023, I will just drag and it will pick all the other retained earnings carried forwards or up to 2027 like that. Up to 2027 like that. Like that. Are we together? Are we together? Are we together, guys? Nancy, what I said about ordinary share capital, we have not seen any elements or any adjustments affecting ordinary share capital. So we haven't done any computations on ordinary share capital. Why haven't we done? we know the factors affecting ordinary share capital. One of the factors affecting ordinary share capital is issue of new shares. When shares are issued, ordinary share capital is affected. And we know there is either issue at a premium and issue at par. We know what those terms mean. So because there was no element of issue of shares, then our ordinary share capital means it's not affected by that. The next element that normally affects ordinary share capital is if there is a conversion of any debt element that is a conversion to ordinary share capital. It will affect ordinary share capital amount for that year. If there are any bonus issue, if there are also any rights issue, it will affect ordinary share capital. But none of those adjustments was mentioned or is there in our question here. None of them is here. So that means because none of those factors is there, our ordinary share capital remains constant across the period. Nancy, have you gotten it?
Okay, thank you. So in short, point number one, if it had something in regards to the bonus issue, rights issue, or any other issue, you would compute the ordinary share capital.
Yes, those factors I've mentioned are the factors affecting ordinary share capital. If they are not there, then it means our ordinary share capital is not affected.
Okay, thanks.
All right. So after that, we've already filled in our retained earnings to 2027, and I believe you know where we've picked the figures from. We've picked retained earnings or retained profits carried forward, and we already have them up here. Even though I want you to note and always remember, you see these are figures of retained earnings that we've carried forward to the statement of financial position. They are bound to change. They will change. Why will they change? Is because remember there is a pending issue of our interest. Remember, interest for 2024 is still blank, 2025 is still blank. So that's why I highlighted this line here. Because interest computation is 10% of the previous year's long-term debt. And long-term debt which we will compute to get our interest will be the balancing figure in the statement of financial position. So we have to get the balancing figure here first. After getting it, then we will compute our interest. And when we compute interest here, it will affect interest being an expense charged in the statement of profit or loss. It will affect our balance at the end of the year, the amount that we retain. So you will see the figures changing, changing simultaneously. When we put long-term debt, it will take effect in the interest computation. And that figure that we have under long-term debt is the balancing figure. So we have to move very cautiously to make sure we check every change at every stage as we will be moving forward. But before we get there, let us fill in the amount of total equity. Total equity is just the total of share capital and retained earnings. So the formula is already here. I will just autofill to 2027 and I have the figures there like that. Those are the total equity. After having my total equity there, we come to the next stage. I will skip non-current liabilities because that is where we have long-term debt. It will be the balancing figure. I will come to total liabilities. Total liabilities, we know it is the long-term debt, that is the non-current, plus current liabilities. Long-term debt plus current liabilities. So that gives us total liability. So also that formula, I will just autofill it to the end like that. To the end like that. So once I do that, I think that now takes care of it well. We come to total capital and liabilities. Total capital and liabilities, you can see if I activate my formula in 2022, it is the total equity plus total liabilities. That's what is giving us total capital and liability. So also, I will just autofill that formula to the end, like that. Now, with that done, the only thing remaining is for us to get the balancing figure, which will be our long-term debt. And at the same time, we take note. We take note of the changes that will happen in the interest computation. But remember, we have interest computation for 2023. Remember, we already have it here, and it is correct. So our long-term debts, as we start computing them in 2023, will only affect interest computation in 2024. Why? is because the value of interest is 10% of previous year's long-term debt. So I want you to look at that connection very well. So that's why our interest computation for 2023 is correct, the 2400. Now, we want to move, and I want you to now look at it very carefully because we will be checking the changes and picking the balancing figure at every stage because it is changing as we move. When you put one figure, it changes. When you put one figure, it changes and it affects even the balancing figure. So how do we move forward? I want us to look at it this way. Let me come down here. Let me come down here. We know that for the balance sheet to balance, we know that total assets is equal to total equity plus total liabilities. That is something we all know. Yeah, it's called total equity and total liabilities. And when you talk about total liabilities, we talk about total non-current liabilities plus total current liabilities. That is what we know. So that means total assets, if I can use initials to represent the same, total assets is equal to equity plus total plus non-current liabilities plus current liabilities, like that. I've just broken down liabilities here to just bring now the two elements, non-current and current. Now, let us make non-current liability the subject of the formula. Why? Why are we making non-current liabilities? Because non-current liabilities, we only have one element, which is long-term debt, and that is the unknown. So we are making it the subject of this formula so that we can now get how to compute it, right? So let's come here and say, how do we get non-current liabilities? Make it the subject of the formula. So you'll realize that non-current liabilities will just be total assets minus equity, and then we also minus current liabilities. I hope we understand how I've made that non-current liabilities the subject of the formula. Total assets minus equity minus current liabilities. Now, having put that and having known that, now we use it to get to compute the value of non-current liabilities, sorry. We get the compute the value of non-current liabilities. Now, to get the balancing figure, which is our non-current liabilities, we want to use this approach of getting the non-current liabilities. And I want to use it here under the non-current liability of the long-term debt there. That is where I want to use it. And to use it there, just put an equal sign. Then we start with the total assets. Where is the total assets figure? Total assets is up here. Total assets for 2023 is 88,000. So I will refer to 88,000. You see it? Then I'm just following the formula that because we are getting non-current liabilities. That is the formula I'm following. Then I'm subtracting total equity. Where is total equity? Total equity is here. I'm subtracting the 42,384. Then I also go to the next part and then we deduct what? Current liabilities. So come here and say less current liabilities. Where is current liabilities? Current liabilities is here. So that is the 22,000. I do that like that. Once I do that, I'm set. I'm going to get long-term debt for 2023. I've not confirmed, but I want you to know what we expect. When I hit enter to get my computation, my answer here of the long-term debt in 2023, what do you expect? You expect a value of interest in 2024. I believe we all get it. There will be a value here. The value here is coming in because interest in 2024 will be 10% of long-term debt in 2023. I hope we are getting it. So it is the value of long-term debt in 2023 that we are computing. And once we have it, the system will compute 10% of it and bring here as interest. And when that is done, it will change our retained profit carried forward. And you see this retained earnings. I want you to look at this again. Retained earnings in 2024. You see this figure of 34,515. You will see it change. It will not be 34,515 because of the effect of interest that will come here. Interest will change this figure, this 34,515. And you know very well, it is the 34,515 retained profit carried forward that is being brought forward in the statement of a financial position. So I want you to look at the change. I will confirm it and you see how things will change. So I will just say Control Enter. I hope you've seen how things have changed. I want you to look at the retained earnings. Now, retained profit carried forward in 2024 is now 33 because already we have an interest here. You see the interest? This interest was not there, but it is computed as 10% of previous year's long-term debt, and long-term debt is what we got. So that is how it has now taken effect, and we have our interest, and these things have changed like that. Good. So up to this point, we have long-term debt for 2023, and we have interest for 2024, like that. We move to 2025. And at this stage, please do not autofill the formula. Do not autofill. Why are you not autofilling? Because the danger of autofilling is you are likely to have a mistake because you have to confirm one first. Once you put a figure for long-term debt here, it affects the next figure. And you know very well we are balancing our statement of financial position. So that's why we are doing it step by step, one after the other. So we've done 2024. Let's go to 2025. We've done 2023, sorry, the long-term debt for 2023. Let us come and get the long-term debt for 2024. And we know, once we get the long-term debt for 2024, we are going to get interest for 2025. And that interest for 2025 is going to change retained profit carried forward, which again changes our retained earnings for the same year, 2025. So that's why, because of that successive changes in every stage, we cannot autofill. We cannot afford to autofill. We go step by step. So let's do the same in 2020, 2024, under long-term debt. We do the same. Put an equal sign. Come and add total assets. We are following this formula. We made our non-current liabilities the subject. So we just say equal to total assets. I've referred to total assets. Then what are we adding? We subtract equity. So come there and say minus equity. Where is the equity figure? Equity in 2024 is this one. This figure 49,523. That is the total equity. Then again, we deduct current liabilities. Where is current liabilities? It is here, like that. We are just following the same formula we already put in. So once I do this, and if I confirm it, you want to see we have interest computed for 2025. And I will go ahead and say Control Enter. And I have my long-term debt here. And you will see, because I have my long-term debt here, already interest has been computed for 2025. And once it is computed, this my figure, our figure of retained profit carried forward has changed, and it is the same figure that has also reflected and changed in our retained earnings section, like that. And you can see our balance sheet is balancing from every stage, every year as we move. 2022 was balanced, 2023 is balanced, 2024 is balanced. Now we come and see how do we balance off 2025. And remember, long-term debt is the balancing figure. So when we put it in, we balance it stage by stage as we move forward. Following which approach? This formula which we wrote. We made non-current liabilities the subject of this formula. And that's how we are getting the figures here. And when we get it, it helps us to compute the interest in our statement of profit or loss. So we move again and do the one for 2025. Come there and put an equal sign. The same approach. Total assets. After total assets, we deduct total equity. Where is total equity? Total equity is this one here. Let me check if it is the correct line. Yes, that is the total equity. Then again, we deduct the value of current liabilities, and current liabilities is this one here, like that. So when I confirm Control Enter, we have long-term debt for 2025. And when we have long-term debt for 2025, it means we already have interest for 2026. Let's confirm. You'll see it's already there. And when interest is already there, you know the effect it has already put on the retained profit carried forward, which has eventually also affected our retained earnings part. So you will see that in 2025, our balance sheet is actually balanced because long-term debt is the balancing figure. So you see it is balanced up to this point. We move to the next step. What is the value of long-term debt in 2026? And when we put the value of long-term debt in 2026, you will see that our interest computation for 2027 will be here. So let's do it here. So equal sign, we follow the same approach. Total assets minus equity minus current liabilities. So I come here, total assets is here, minus total equity is this one, minus total current liabilities. Where is current liabilities? It is this one, 29,282. Let me just confirm if it's the correct one. Correct, it is the one. I confirm, control enter, and I have my balance sheet balancing in 2026, and I should also already have interest computation in the year 2027. And you can see interest has already been computed here. We have the interest already there. So that means with the interest already captured correctly, we can now balance off the last year, 2027. Interest is correct. That means retained earnings or retained profit carried forward, this 6319 is correct. And it is the one that is again reflecting in our retained earnings section in the statement of financial position. So let's go ahead and now do the last balancing. The last balancing, we follow the same approach, equal to total assets. Total assets is up here. Total assets, then we deduct total equity, which is this one here. Then again, we deduct total current liabilities, which is 32,210 here. Then I confirm, and you can see our balance sheet is balanced for all the years. We can confirm all the years are balanced like that. Are we together, guys? Confirm if we are all together. Are we all together there? Good, 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 good. If we are together, this is very nice. This is very nice. This is very nice. Good. And I see today some people refuse to wake up. Yesterday we were almost 80 people. Today we are only 63. There are guys who have slept, or maybe they were not able to make it, but it's okay. Let's hope they are all okay. Someone is asking
Mwalimu,
something. Yes, go ahead.
let me see your non-current assets.
Non-current assets.
Mm.
You have different figures for non-current assets.
Yeah, yeah, na nilichelewa kuamka, sorry. Just put the formula there so that I can see what you did. Don't want to take you back.
No,
At the
non-current assets,
61 percent.
you just apply the growth rate of 10%. That's what we did. You see the 10% I've written in this column.
I don't know what happened because I see I applied 15. I think I was still sleepy.
Oh, now that is the danger of sleeping and
I
joining
applied
late.
I applied 15. I don't know what happened. It's our thank you.
So what you do, we made some
Mm.
corrections, though I'm not going back to do all the computations, but there were adjustments we did. Make sure you change in the note 3, Roman number 3. That rate of 15%, that was the depreciation and amortization to grow at the same rate as non-current assets. That 15% which was there, we changed it to 10% after. That was the change that was done in that sitting. It was a mistake, but it was corrected to 10%. So make sure your non-current assets, you grow by 10%, not 15. And then also your depreciation and amortization, use 10%, not 15. Then the next correction which we did was in note number 3, Roman 4, where the previous interest expense about 10% of previous year's long-term debt, there was a section which was added, which will grow at 20%. The correction that was done advised that you do away with that part of which will grow at 20%. So there is no growth rate in long-term debt. So you stop at long-term debt like that. Then note number 5 remained the same, and note number Roman 6 remained the same. So those were the only two adjustments to make. And if you make it, you should be able to come up with the same figures that we have.
Thank you. Yangu iko sawa sasa.
Good, good,
Just
good,
change
good.
the rest, everything else is okay.
That's very good. That's very good. So guys, let's move to the next level. We already have our model financial statement. So what is the next level? Remember, we now want to narrow down to the cash flows. After coming up with the statements, forecasted statements, now we look at the cash flows. And the cash flows is what is going to help us to value this company using free cash flows to the firm, free cash flows method. Now, how do we come up now to narrow down and look at the cash flows? Let us start by listing the years. The years that we are dealing with, we have year number 2023, we have 2024. That is the years of forecast. I'm not starting with from the initial year of 2022 because that was the base year and it has already helped us to come up with the model. So let's start from there to 2027 like that. Those are the years that we have their projections. And then after the years, let us now narrow down and start looking at our income, the cash flows now. What is our net income? And how do we even give this approach? Remember, when you are doing the statement of cash flows, we were starting by the profit before tax. Profit before tax. That is where we were starting, right? Profit before tax, before you charged your tax. Yeah. So, and then from there, we did adjustments. To it. So I want us to look at our model statement of profit or loss and bring here a net income. Then we adjust it appropriately as we follow to look at an income which is unlevered, income which is free. Remember, we are using free cash flows method. So we are looking at getting unlevered income. You know what is leverage? I believe you know what is leverage from your FM knowledge. So let's bring net income here. Now, in our model statement, let me put an equal sign, then we go to 2023. In our model statement of profit or loss in 2023, what is our net income? You can see our net income is here and it is 10,640. That is the line for net income. So we pick that net income and bring. The income we are picking is before dividends. That is the net income before dividends. But it comes after. We charged interest and also we charged tax. Yeah, interest was already charged. If you look at these expenses which are above here, we charged interest. Also, there was a charge of depreciation and amortization. You remember that? Depreciation and amortization was charged, then was deducted before interest, and then also eventually tax was charged. I believe you know that. But because we are looking at cash flows, you know how we are going to treat depreciation and we know how we should treat tax into the effect of interest. So let's come and bring first the net income. So I've picked net income for 2023 and I will autofill the rest for 2024 to 2027 like that. Those are the net income figures we already have up there. Now after that, for us to get the unlevered income, we come there. That is a free income. Unlevered means it is free. It has no any debt attachments to it. So we come there and remember, the adjustments we normally do in operating cash flows when preparing statement of cash flows, we normally do adjustments on depreciation. We normally do adjustments on finance cost. Those are expenses that are being charged, but they're just charged on accrual basis. It does not mean money has been spent. I believe we know that. Depreciation and amortization, then interest expense. They are charged here, but let us correct it. Because they affected our net income, we deducted all this from our revenue. Yeah, so that we get our net income. So because they affected our net income and they did not involve real flow of money, let us correct our net income by adjusting back depreciation and adjusting back our interest. So let's do that. We come here and say add, because you know finance cost was deducted, so we are adding back, add finance cost. But I hope you remember the finance cost we are adding back is a finance cost net of tax. I want you to get that part very well. Net of tax. So let me just put it in bracket, net of tax. So that is very important. We make sure we add it back, net of tax. So let me do some adjustment here. Let me do just some adjustment here. I know those cells, I don't want to do an automatic adjustment because it will interfere with the alignment here. So I leave it at that. Good. So net of tax. How do we bring on board finance cost net of tax? It is very simple. It is very simple. We just go and pick our finance cost charge for 2023. Where is it? I will put an equal sign and go to our model up there. Where is finance cost? Where is our finance cost? Interest is here. For 2023 is 2,400. And as I pick it, net of tax means I'm multiplying it by bracket 1 minus. What is the tax rate? What tax rate were we given? Look at note number what? Note number, which note is it?
30%.
It was not given in the notes. It was given in
Yeah.
the statement above here. Tax at 30%. So 1 minus 30%. 1 minus 30%. We multiply by that interest expense which was charged. So that's how we are getting interest. We are getting finance cost or interest net of tax. So once I've done that for the year 2023, I don't repeat. I just autofill my formula to 2027 like that. To 2027 like that. I hope we've all seen it and I hope we are together there. After we have this, but then you can see it is coming as a negative, but actually we are supposed to add. So I need to introduce some negative here in the first computation so that it comes as a positive. We are adding it, we are not subtracting like that. Good. After we have that, we now get to see this is what will give us unlevered income. Unlevered income. Unlevered income.
Sasa,
Then, yes?
hiyo ya finance cost ni wapi imeandikwa it's net of tax? Kama ni wapi sijaelewa hapo.
It is not written anywhere. It is net of tax. It is us who are now bringing it in net of tax. It is not written anywhere net of tax. It is us who are now computing it net of tax. Are you getting it?
Mbona una less one?
Mwalimu,
Yes.
me, I've always known it's less. Yes, we add less of tax, but I've never known why we less tax. Because na feelingi, it is just meant to be carried vile iko, add finance cost vile iko. Why do we normally less tax?
What is the meaning of unlevered income? Do you know the meaning of unlevered income?
Unlevered income ina debt.
Exactly.
Mm.
So
Mm.
you know very well that tax is normally charged, right? I want to give you an example. If you have any loan in a bank or any financial institution, when you look at your loan repayments, do you normally see tax considerations?
No.
Are you sure?
Repeat the question, Mwalimu. Repeat the question.
When you pay interest on debt, for example, if you have a loan from a bank or any financial institution, do they normally put tax adjustment?
On what?
In other words, do you pay tax when you pay interest?
No.
No, we don't.
Good. Now, if we don't, when doing our statement of profit or loss, let me go back there and show you. Statement of profit or loss here. Here. Now, we deducted interest before we charged tax. Why? I'm waiting.
Haikuwa na tax.
Why did we deduct interest before we charge tax?
Because when you're paying interest, you're not, let's say interest is tax allowable.
It is tax allowable. That's a good language. Good. Now, when you are using a free cash flows method, yeah? And I want you to look at how we compute free cash flows. Let me not even bring the word free first. Let me talk about cash flow statement. in a cash flow statement, we normally start from profit before tax. Why do we start from profit before tax, not profit after tax? As you think about it, look at the revenue in our statement of profit or loss. Look at a business or a real operating business in whichever sector. Do you normally pay tax when you generate revenues from your business?
Yes, we pay taxes.
You pay taxes, that is correct. If you pay taxes, does tax affect your cash flows?
Yes, it does.
Very correct.
Depending on if you are paying on the installment tax or you're paying the balance of tax in that related particular year.
It's okay. Leave alone the method of paying. The fact is, are you paying the tax?
Yes, we pay.
Yes.
Yes,
Yes, we pay.
you pay the tax. Good. If it affects your cash flows, now that tax you're paying will be an outflow. Is that correct?
Correct.
Very good. Now, when we were doing our statement of cash flows, you know very well that under adjustments, you remember that formula of dial God's number for food, or you'll rest in peace. If you remember that formula, you know very well that tax is not falling under adjustments. Tax is not falling under adjustments. And
Correct.
before I go to the next bit, tell me, why is tax not adjusted under adjustments of cash flows in under operating activities? Yet, it is one of the expenses being charged in the income statement. Let us just start from there. Then we go to the next step for understanding. Why is tax not an adjustment under cash flows from operating activities? Tax is not an adjustment. Why? Before we go
Because
to the
tax
next
is
part.
not an cash. We pay. That is something that we pay. Like we throw our money, take to the bank and pay KRA.
Yes.
Because that one is just a declaration. It's the tax which is in the profit and loss account. It doesn't mean that it has been paid.
Even interest doesn't mean it has been paid. The
But
same
it definitely
depreciation.
Tax
Why
is
why is tax
compulsory.
exclusive?
What I can say is
Very good.
that when I want to look
Someone
at
was unmuted. There is a lot of interference. Guys, when you unmute, remember to mute back because the interference becomes a bit disturbing. Okay, good. So guys, I want us to picture that. Let us picture a statement of profit or loss or an income statement on one end. Let's have it. Let's have that picture and look at where we are starting from and the perspective into which we are looking at it. We are looking at a statement of profit or loss. Or in other words, let us look at an income statement. Remember, you are generating revenues from operations, whether it is sales or revenue, either term, it means you are getting income from your operations, from the business you are doing. Now, there is a tax that you pay from that income, and we know that is automatic. You have to pay income tax. Now, when you are following up on cash flows, when you're following up on cash flows in the statement of cash flows, you know very well that you do not adjust tax under non-cash items. You do not adjust tax because even though the tax being charged in the income statement does not mean you've already paid the whole of it. No, but eventually you will pay the tax. It might be fall under deferred tax. It will be deferred, it's okay, but it will eventually be paid. That's why in the cash flow statement, we do not adjust tax as a non-cash item, but immediately after considering all the adjustments and also after looking at changes in working capital elements. I want you to picture that cash flow statement the way we did it. After doing the effects, the changes in the working capital adjustments, then you know very well we narrow down and now bring these two elements. We normally bring interest expense paid or finance cost paid. Then we also say tax paid. Do you remember that part? I want you to picture that part. Interest expense paid and then tax paid. Those two elements normally come after that. And you know very well that interest expense paid must not fall under operating activities. You can charge that interest expense paid under financing activities. You'll still be correct. You are not restricted there. But assume we treat it under operating activities. You will bring the line of interest expense paid. I don't want to type all those things now because it will waste a lot of time, but I want you to picture it as I say because we've done it several times. Then we also say tax paid. Tax paid. We only narrow down to what was paid. We didn't adjust it under non-cash. We did not adjust it. But now we ask ourselves, how much out of the total tax charged, how much out of what was charged in the income statement are we actually paying now? Because this is what is affecting our cash flows. We are not saying it's an uncash item. Up there, we did not adjust it. But we only narrow down and look at how much out of the total charge are we actually paying now. That's what we are doing. That's now the perspective of looking at it in terms of cash flow statement. Now, come here to what the situation we are handling now. We are using an approach called free cash flows. The approach we are using is free cash flows. Free
Mwalimu,
cash flows method to do valuation. Yes.
I think the member's question was, why do we add back the tax, the financial cost net of tax? That was her question, if I got it right.
Yes. So
Instead, in the cash flow statement, we just add it direct. You know, the profit before tax, and then you add the tax or the depreciation, something like that. Why here we are adding it net of tax? And why can't we add the depreciation also net of tax? In layman's language, that is what the member was trying to put across.
I'm listening. Go ahead.
Yeah, okay. Because I've listened to your explanation, but according to me, I was also interested to know why are you adding it net of tax? And maybe, to my understanding, I've not gotten it. Why?
I think that's what we are still talking about. Is it?
Alafu mwalimu, to add on his question, when do you know it's a free cash flow and unlevered and a levered one?
Yes, I'm still on this gentleman called Haman.
I think I'm gonna cut you short because that you are in the process. You are in the process of explaining why finance cost
Okay,
is
okay.
paid net of tax.
Sorry then. Sorry.
Yeah, there was an interruption there.
Yes, so let's just proceed with it up to the end. Then you are asking that question after we have finished the explanation so that you see, did you understand or you did not? Right?
Thank you.
Good. So now,
Mwalimu, before you continue, why didn't we pick earning before tax, like profit before tax, and we picked net income in this question?
very good, very good. Now, I want to tie those two questions about net income and profit before tax. Net income and profit before tax, so that we get to marry the two and understand why finance cost is added net of tax. Let's all go to the statement of profit or loss, statement of profit or loss, which is up there. Now, in the statement of profit or loss, we normally usually start from profit before tax, which in this case, it is the same as earnings before tax. You see that part? We normally start from there. That is how we normally compute our statement of cash flows from, right? Now, when we pick it from earnings before tax or profit before tax, let me just include that other part. Profit, that is profit before tax, like that. My keyboard. Okay, good. So profit before tax or earnings before tax. This is the amount that we normally pick when we start computing our statement of cash flows. I believe we all know that. But now we have started from net income. Net income. The income that you get net after you've already paid what? You've already charged. Let me use the word charged. You've already charged your tax. And that is why when we come to use this approach of free cash flows, we come and start from, if we start from our net income, now this finance cost, we already charged it in the income statement and we've already charged the tax. I want you to look at this. Tax is already charged on that earnings before tax. So actually this net income is in other words, you can call it profit after tax. That is simply what it means. Net income is actually profit after tax. It is a profit after we charge the tax. Why do we pick profit after tax when computing free cash flows? That is the question I want you to look at. Why haven't I picked on profit before tax or earnings before tax? It is very simple. Remember, we are valuing a company and we know very well that when valuing a company, this tax that is being charged, the tax they will pay on the revenues they generate, they will eventually pay the whole of it. Right? And because they will pay the whole of it, when we come to the amount we start computing with, we pick the amount after the tax has been charged. Because they are going to pay the whole of that tax after tax has been charged. And when we look at the interest that we are adding back, already affected this profit. Right? And again, the tax that was charged at 30% has already affected this profit. So when we are adding back this interest, we have to consider tax because tax has already been charged here. Are we getting that part? Is it making sense, guys?
Mwalimu, so in short, the interest, us adding it back, was not charged the tax. That's why we have to charge the tax.
Sorry, come again, ask again.
I'm saying, see, we are adding the interest here, but hapo juu, the interest was not charged the tax, right?
Yes.
So tuki-add hapa lazima to charge your tax.
Yes, and I want you to look at it from the terms of the income that we are working with. We started from profit after tax, not profit before tax. Are you looking at it that way first? Tax has already been charged. And tax not being an uncash adjustment. We normally don't adjust tax as an uncash item. But because we are starting from a profit where it has already been charged, when adding back our interest, we bring the interest net of tax because tax has already affected the overall income. The income we picked is income after tax, net income. That's why when we are bringing this finance cost and adding it back, we bring it net of tax. That is what free cash flows demands us to do.
It's clear.
Because tax was already charged. Guys, are we together?
Yes, yes.
It's clear now, Mwalimu.
It's clear. It's understandable now.
Good. So the only thing about some of these computations, yes, someone is asking something again.
Mwalimu, me, I wanted to ask. It's clear, yes, I've understood you. So if somebody else could have started with PBT, angekuwa wrong.
You are not supposed to start from, okay, you are not supposed to start from PBT because remember, we are not preparing statement of cash flows. We are looking at the net free cash flows of a company that we want to get its value. Are you looking at the two objectives? I'm not saying if you start from profit.
Wait, mwalimu amalize your statement.
Mwalimu, hata tukianza kwa EBIT, we will arrive at the same
It will be the same. The only thing is that I don't want to give you a lot of approaches because you'll end up getting confused in between. You know,
Okay.
when you have a lot of options to go with at the same time, you might reach a point where you don't know which one to use at what time. So that's why sometimes it is safer, pick one route, and once you've known how to go about that one route, stick with it so to avoid wasting time or getting confused in an exam room. So when you get to an exam, to make just your life easy so that you don't have to think too much, don't think too deeply because you don't even have that time to reason in an exam room. So kindly just go and pick profit after tax. Yeah, I'm not saying if you start from profit before tax, you are wrong. You are not wrong. The only thing is that I don't want to have so many, so many ways of doing it, but you may as well just do that. You can go and bring here profit before tax, profit before tax. In our case, it is called earnings before tax. You can as well start from there. And when you start from there, now you will not bring anything net of tax because you've not charged tax. Are we together?
Thank you. Thank you.
Good.
Now, thank you.
We've not charged tax. So when you bring it here, you just make sure you don't interfere with any tax thing. But when you start from net income after you've charged tax, make sure the finance cost, bring it here net of tax. That is okay.
Excuse me, mwalimu.
Well
Mwalimu,
understood.
situtumie hiyo tu ya tax basi.
You can as well do it on your end, but as for me, I prefer this approach of adding back finance cost net of tax.
Excuse
Madam, it
Yes.
is clear.
So you can do it on
Excuse
your
me,
end
Akaza.
and we compare. Do it on your end with that approach where you pick it before tax. Then we will see, are we arriving at the same answer? Eventually, we will arrive at the same point. Yeah. Now, let us get our unlevered income here. Unlevered income.
Have you Akaza at 1680? I had the issue with my network.
Sorry?
Have you Akaza at 1680? I had issues with my network. I just see where we have add finance cost. You Akaza at 1680. I see the computation there.
1680. We've just brought in finance cost net of
Asa.
tax. Net of tax.
Thank you.
Good. So we have our unlevered income there to 2027, like that. After having our unlevered income, now we ask ourselves, what other adjustment, what other element was charged in the income statement that we need to adjust back? And it is depreciation. We know that depreciation is normally does not affect our cash flow. So we add back depreciation. Let us add back depreciation. Where is depreciation? It was charged in our income statement up here. Depreciation and amortization. Kindly mute back. There's a member who was unmuted and guys forget to mute back. Okay, good. So I was picking this depreciation for 2023. Depreciation and amortization 2023, it is 4,400. Because I'm adding back, that's why I'm putting the negative so that it comes here as a positive. And because I've done reference to that, I just drag to 2027 and there I have it. Then,
Mwalimu,
yes.
while at it there, please, allow me ask. Sasa hiyo wametupea depreciation and amortization. So in an instance where they have just given amortization peke yake, how do I deal with it?
You will still add it back if it is exclusive.
Okay.
Yes, good. So we come here and after bringing back our depreciation, then we also make sure we take care of any changes in working capital and also any changes in capital expenditure. We know those elements affect our cash flows, right? So I will come here, and before we come to changes in working capital and changes in capital expenditure, remember, this is a model cash flow statement, but in a different perspective. We know very well that after doing adjustments on our profits, after correcting our profits, we normally look at working capital changes. We normally bring the elements of working capital changes. And then under investing activities, we also normally consider changes that take effect in the fixed assets or the non-current assets. And that changes, we normally call it, or changes in capital expenditure. under investing activities. So how do we know the changes in working capital? Changes in working capital. Which elements are we looking at? Which elements are we looking at? I want us to do working capital changes. We know what working capital is. So I just want to create some space here and do it down here. Working capital. What elements are we looking at when you talk about working capital? We know working capital is current
Inventory.
assets minus current liabilities. That is what we know. And then I want us to look at them, the elements of working capital across the year. What changes are taking effect? What changes are taking effect from 2023 to 2024, all the way to 2027, like that. And I want us to look at current assets less current liabilities, current assets less current liabilities, and you will look at it from the statement of financial position that we were given. Statement of financial position. We pick current assets, then we deduct current liabilities. That will give us changes in working capital. So for year one, that is 2023, what changes do we have? What changes do we have? We come here and look at it. In 2023, what is the current assets figure? Current assets figure in 2023 is this one. Then we deduct current liabilities, which is 22,000, like that. The change there, the figure there in working capital, changes in working capital there, I'm having 4,400. And because I've done reference, let me see if I drag, if it will pick the correct items. Yes, it will. It will pick that, and then it will go successively to the next years. So I just drag to 2027. So those are the working capital elements. So this is working capital in 2023, 2024, 2025, all the way to 2027. These are not changes. These are just working capital. These are just working capital because I've just gotten the difference between current asset and current liabilities. So what are the changes now? Changes. What are the changes now? Changes in working capital. We know what a change is. We know what a change is. And to get the change in working capital, we check the working capital currently in the current year. We compare with the working capital in the previous year. What change took effect? Yeah? What change? How did it change from previous period to the current period? That is what we are looking at. And in that case, I will be forced to bring on board the year 2022 here also, because we need to compare the change that took effect from 2022 before we came to 2023. So what is the working capital in 2022? It is current asset. I believe this is the figure for current asset. Let me just confirm. Then we compare it with current liability. So for 2022, working capital is 4,000. So we want to look at what change do we have? How did it change from 2022 to 2023 and 2023 to 2024 all the way to 2027? What are the changes? Now, to get the changes, in 2022, we don't have a change because we do not have the figures for the year 2021. So we will get a change in 2023. The change is the current period's figure, working capital figure in the current period, we compare with the figure in the previous year. We are getting the change in working capital. And in this case, I'm having a change of 400, right? And because I've referred to it this way, I've given a pattern. I believe if I drag to 2027, it will pick the changes to the end. And we can confirm the 2026 one. It is the current year's figure of working capital compared with the previous year's figure. The same in 2024, it is the current year's figure compared with the previous year's figure. That's how we are getting the change in working capital. So that is the changes in working capital that we consider to affect our cash flows in our model above. I hope we've gotten it. I hope we've gotten the changes in working capital, how we compute it. Now, that change in working capital is what we bring up here. Is what we bring up here because it affects our cash flow. And we know that working capital changes will affect our cash flows. For example, if you talk about inventory, because we know inventory is an element of working capital. We talk about inventory. If inventory increases from, for example, 1,000 to 2,000, it can only increase because you've bought more of the inventory. We know that. We've bought more of inventory. Yeah. So when you buy more of inventory, that is a cash outflow. So these changes in working capital, for us to get a net free cash flow, we have to take care of changes in working capital. So we will come here and say less changes in working capital. And we've already tabulated the changes. So I will just put an equal sign and refer to them. And as I refer to them, because we are deducting, I want to bring them here as a negative. So I will pick the change in 2023, bring it on board. Then I just autofill the rest, bring all the rest to 2027. Those are the changes in working capital. Good. After that, we go to the next section of investing activities and look at changes in capital expenditure. We will also deduct them here. Less changes in capital expenditure. Less changes in CapEx, capital expenditure. Now, let us do the computation of changes in capital expenditure here also. Changes in capital expenditure. We know that this one now affects our non-current assets. So let me just write there also non-current assets so that someone can see. This one is about non-current assets. And we want to narrow down and look at the non-current asset elements. The same way we've done with the current assets and current liabilities, we again go back to the statement of financial position and look at the non-current asset elements specifically. So we come here and again list the years. We are starting from 2022 because we are doing comparison. We are looking at changes. So when looking at the changes, we have to start from a previous period so that we get to see how it changes over time. We know that statement of financial position records the values of these non-current assets at book value, net book value. So let us pick the net book value of the non-current assets from the statement of financial position. Where is it? Non-current assets are here. You can see you are even told they are all at book values. But even if you are not told, you know preparation of statement of financial position is at net book value. So we pick the value in 2022 like that. Then because I've done reference, I will just drag to 2027 like that. Those are the values of the non-current assets at net book value. Then what normally affects the value of the net book value of our assets? What affects our assets? What normally reduces the value of assets or increases the value of assets according to the knowledge we already have in FR? Yeah.
Depreciation.
We know the
Purchases,
yes.
disposal.
Good. We know
Purchase
that
and disposal.
we know disposal affects it. We know if you buy more, it affects it. We know that depreciation affects the value of
Depreciation.
our non-current assets. Now, let us come and consider depreciation on the value of our assets. Depreciation charge. Now, how do we bring on board depreciation? Let me just type the depreciation and we go and look at the depreciation figures. So in 2022, what depreciation charge was there? In 2022, I can see depreciation charge was 4,000. Depreciation charge was 4,000. So I will refer to the depreciation 4,000, then bring it on board here. And because I've done reference, I can just drag to the end like that. Then,
Mwalimu, if I may,
yes, go ahead.
my assumption was that when we are told it's net book value, then it means they have already incorporated the issue of depreciation.
Ah, good.
That was my next question.
Good. That is correct. But it was the net book value for the 2022, right? In 2022, net book value, because this is the statement of profit or loss, we know very well that statement of financial position figures are brought at net book value. Did we have any accumulated depreciations here?
The assumption is yes for my attempts.
What do you mean, Aman? What do you mean by that? By my attempt?
They didn't show it, but since it is a NBV, then it means that it was taken care of.
It was already taken care of.
Yeah, there is no accumulated depreciation.
Mwalimu,
It was net book value.
mwalimu.
Now it's okay. There is no problem. Now, I want you to look at it this way. I agree that the statement of financial position has all the figures it at net book value. And I've also written here net book value. Are we all seeing that? Are we all seeing this net book value? I've
Yes.
put it here at net book value. And it is not by mistake, guys. It is not by mistake. The only problem that we Africans, like if I can call ourselves Africans, is sometimes we forget to look at the objective. Remember, we are not preparing changes in capital expenditure so that we get the net book values. That is not our objective. Our objective is to get to see the changes in capital expenditure. Do we know what capital expenditure is? Capital expenditure is usually at cost. Remember that very well. So don't forget objective. As much as I'm bringing net book values here, our objective is to get the changes in capital expenditure. Changes in capital expenditure are changes in the cost. We are looking at the cost aspect. We know that to arrive at the net book value, you started from cost. Remember that. Remember, we were not told to compute depreciation. We did not compute any depreciation. It was given to us. For the projected years of 2023 to 2027, we only used a figure that was already given to come up with projections for the next 5 years. We did not compute that depreciation. That means we do not know the cost of these non-current asset elements. We did not know the cost because already we were given the final product, which is the net book value. So all these things, even the net book, the book values that we have for 2023 to 2027, these are all net. They are all net. But the objective is looking at the changes in capital expenditure. Capital expenditure is the effect on cost, not on net book value. So before we rush to, to look at, to ask, let us first look at the objective. What are we looking at? What are we chasing? What is the objective? The objective is to get the cost of these elements. Then we see what were the changes in the cost of these non-current assets from year 1 to year 2 to year 3, like that. That is the objective we are looking at. And we know depreciation was already deducted to bring us the net book value. So for us to get the cost, we work backwards. And actually this depreciation, we need to bring it here as a positive because I want us to work backwards, add it backwards, so that we look at the cost and we narrow down to the changes in the cost of this item. That's why I asked the question, is there accumulated depreciation in this question? A member there said it is there, but at the back of a tent, right? And that acknowledging it is there alone should be enough to trigger the thought of your objective here. Now, we have to get the cost of these non-current assets. They're all at net book value, and we are not preparing statement of financial position. It's already prepared. Our objective is to get the cost. So let's come here. To get the cost, we normally add back depreciation. And when doing depreciation, because we are working with successive years, this depreciation charge in 1 year will be accumulated as you move to the next year. It will accumulate as you move to the next year. That's why I asked you guys if there is accumulated depreciation. That's what I was arriving at. So depreciation charge in the year 2022. If you come to the year 2023, the total accumulated depreciation will be the total of the depreciation charge in 2022 plus depreciation charge in 2023. So let us come here and say accumulated depreciation. Accumulated depreciation. And the accumulated depreciation for year number 2022 is only 4,000 because we do not have the previous year's charge of the depreciation. But when we come to 2023, accumulated depreciation is the current year's depreciation charge plus what was charged in the previous period, the year 2022. That gives us the total accumulated depreciation for the year 2023. Then that pattern, we are going to maintain this pattern, adding the current year's charge to the previous year's accumulated. So After I put that pattern formula, I will just autofill to 2027. And I have my accumulated depreciations across. Remember, our objective is to get the cost. We are working backwards. We already have the final product, but now we want to know what was the cost of these items before that depreciation was charged. What was the cost? That is our interest, so that we get to see, were there changes in the cost of this item? And that's what will lead us to get the changes in capital expenditure. It is normally at cost, guys. So objective, very important. Now, after we have accumulated depreciation, how do we normally work to get the net book value? We normally deduct the accumulated depreciation. So we normally consider accumulated depreciation, and accumulated depreciation has already taken care of depreciation charge for that year. We know that the total depreciation to affect the value of the asset is accumulated depreciation plus the depreciation charge for the year. Now, if we have total accumulated depreciation, these ones here have already taken care of the current year's charge. I hope you are seeing that. Current year's charge were these ones. And then we've done accumulated, meaning whatever depreciation that came from the previous period has already been taken care of. We've added the current and the previous like that to get the total accumulated depreciation. So to get the cost of these items, to get the cost of these non-current assets, we add the net book value that we already have plus the accumulated depreciation now. We are not adding depreciation charge, no. We are adding the accumulated, because you have to take care of the accumulated when computing net book value. We are simply working backwards now. And that gives me a cost of 60,000 for 2022. And then I just autofill to 2027. Those are the costs. Those are the costs of these non-current asset elements to 2027. But what is our objective? Our objective, after we have the cost, we look at the changes in the cost. The changes in the cost. And that's where capital expenditure comes in. So we come here and say, therefore, what are the changes? What are the changes in CapEx? What are the changes in capital expenditure? If in 2022, the cost was 60,000, but when you come to 2023, the cost is now 70. What happened? They must have purchased more of these non-current asset elements by spending 10,000 more. That is a capital expenditure. From 2023 to 2024, the cost increased from 70 to 81. There is an extra 11,000 that they spent. That is a change in capital expenditure. That is an outflow. That's what we are looking at. So that changes in working capital, in the capital expenditure, we don't have that change in 2022 because we do not have the previous year's cost to compare with this current year's cost for 2022. So we start by looking at the changes in the year 2023, the years that we built its model financial statements. So I come here and compare the current and the previous, and I'm seeing that changes in capital expenditure for that year 2023 is 10,000. Then we do the same for all the other years, and that gives us the changes in capital expenditure. And the approach that we've given this is very simple. It is very simple. We were given net book value. And we know what net book value is. Net book value is usually just the cost minus accumulated depreciation. That is the approach that we followed. Yeah. And we know that cost. We know that cost is, again, we are just reversing. We are making cost the subject of this formula because that is what we were looking at. Now, if net book value was cost minus accumulated depreciation, so how do you get cost? We've just taken the net book value, then we added accumulated depreciation. That is how we arrived at the cost. And now we are looking at the changes in the cost itself after making it the subject. So we have our changes in capital expenditure. Are we together, guys? Are we together?
Yes.
Very good.
Yes.
I love the silence that has been there for the past 5 minutes. It's very encouraging. Very good. Very good. And I believe someone has understood that. Now, changes. Now let us come and now list the changes in capital expenditure. in our computation and following up on the cash flows. So I will come here and bring them in because we've all seen that actually they spent these monies to buy more of their non-current asset elements. So I will come there and autofill to 2027 like that. Very good, very good. There you go. So after I bring in all the changes in working capital and changes in capital expenditure, now what we are going to get are the free cash flows. We are going to get the free cash flows. So let us now get the net effect and have our free cash flows. Then from there, we can now easily get to value this farm. And how do we get the free cash flows? It is the net effect from the unlevered income. Remember, we already have unlevered income. So we're just getting the net effect from here. Unlevered income, then we add back depreciation, then changes in working capital and changes in capital expenditure. So for year one, I'm getting 6320, and to the year 2027, those are the free cash flows. Now, it is at this point that we now narrow down because we are already at home stretch. We already have everything we need. We have everything we need. We now just go to a next step and now get the value of this farm. How do we get the value of the farm at this point? Now, we must ask ourselves, what information haven't we used? What information haven't we used in the additional information given by the examiner? You see, there was that additional information number 1. We have not used it. It is the point now we want to use it. Additional information number 2 about the debt. We are going to use it now. Then additional information number 4 was about the cost of capital. And then finally, additional information number 5 about the growth in the farm's cash flow from the year 2028. So those elements, we now want to use them here. How do we use these elements to get the value of the farm? Very simple. Now, what are we looking at? Our interest is to get the terminal value. What is the terminal value of this farm? That is what we are looking at. Using the free cash flows model, for you to get the terminal value, because that is the required. What is the required? Determine the value of N limited. That value we are looking at is the terminal value. To get the terminal value, there is normally a formula that you use when you are applying this free cash flows method, and the formula is very simple. Terminal value, normally you just say equal. This is the formula. I'm putting that apostrophe so that it doesn't give me an output, because it will not. So we normally pick the free cash flows. We normally pick the free cash flows at year 0. The free cash flows at year 0. And I want you to note very well, when I talk about free cash flow at year 0, that we are talking about terminal. The word here is terminal value. So when I say here at year 0, I know someone is asking, which one is now year 0? Very good. From the word terminal, you should know which one is treated as year 0. Then we multiply that cash flow by 1 plus growth rate. Which growth rate are we talking about? Growth rate in the cash flows. Let me use a small g. Growth rate in the cash flows. Then after that, we divide what we are getting. By the weighted average cost of capital, or the discount rate. Then we less again the growth rate. Close that bracket. That gives you the terminal value of this farm. That is the formula. Now let us now follow this formula and get the terminal value. From the terminal value, the value at the end, from value at the end, we are now going to get the present value of that terminal value. We are now going to get the present value of that cash flow. After getting the present value, now we take care of the total current liability. You see, we are told that the current debt is that amount. After taking care of the current debt, we are going to get the value at the end, the value of the farm today. We are going to get the value of the farm today after doing the discounting of those terminal value that we'll be having at the end of it. Now, we come here. For us to do that, we know very well that, let me bring those two elements that we were given up there so that we can refer to them here. Which elements we are talking about? This is our formula here as the weighted average cost of capital, and we were given the figure. Where is it? We were given the figure as 18%. 18%. Then we have also the growth rate. Growth rate also we've been given, and the growth rate is given in note number 5. It is 3%. So bring that growth rate here, 3%. Now let's apply these two to get the terminal value. Let's apply the two to get the terminal value. I'm looking at the charts here. I'm seeing people have wrote a lot of things. I want to just see if there is a question there. Okay, Becky has even given us another formula there, which is the same. Yes, using the DO, the district officer. You are still okay. That is good, Becky. So let us follow this our formula here. Now, you can either go the route of the district officer formula, which you did in AFM, that Becky has even reminded us of in that chart. But then let's just look at it from the understanding point of view. We are looking at the terminal value. So let us follow it the same. We say an equal sign, then we pick the free cash flows at year 0, which is the terminal value. Terminal value. What is the terminal value? It is the free cash flow at the end, year 2027. It is this 9253.11. That is the terminal value we start with. Now, that terminal value we multiply by, open a bracket, say 1 plus growth rate. Which growth rate? We refer to this 3% box, that cell there. That is the growth rate. Close that bracket. Then you divide by, what are you dividing by? We are dividing and opening a bracket, open a bracket. You are dividing it by weighted average cost of capital, refer to where there is 18%, then you deduct the 3% again. You are deducting the 3% again, which is the growth rate. I refer to that cell again. I close bracket. How many brackets do I have? I have, we are dividing the whole of this other part, weighted average cost of capital minus growth rate. We are dividing everything from the first end. So I have also to introduce a bigger bracket here. So that means I have 2 brackets to close at this point. So I'm closing 2 brackets like that. Good. So we are dividing everything from the first computation with everything in the second computation. But in the first computation, we have to add, we have to multiply by 1 plus g. I hope you are understanding the 2 brackets that I've introduced there. So when we do that, we are going to get a terminal value of, I can see here I have 63,538.04. Yes.
Mwalimu, you said free cash flows at year 0.
I've stressed enough that we are talking about terminal value. Value at the end. At the end. Free cash flow at the end. Writing year 0 here does not mean now it is at the start. No. Remember, these figures we are working with, this is a model of forecasted statements. You know that. You remember that, right? These are future cash flows. These are future time. So when I talk about free cash flows at year 0, I do not mean that it is the current. No, these are future values. And because it is a terminal value, the term here is terminal. We are looking at the value at the end, the terminal value. That is what we pick. Are we together?
Okay.
Good, good. So after we have the terminal value, guys, whatever is remaining is just to discount. Discount those terminal value, discount the terminal value, which we already have. You can discount it. And once you discount it, you can discount it using the discount factors, or you can use the NPV formula if you'll understand it best. But you can use PVIF. You can use PVIF. PVIF is the discounting formula, and you use 18% as the discount rate. After you discount, please go ahead and now get the present value. Get the present value using NPV formula of those free cash flows. After you have that, take care of the liability, which you are given in note 1. Note 1, we were given a loan of how much? Note 2, sorry, a debt of 24 million. Take care of the debt and get the net value. And with the net value, you are already given even the number of shares. So get the current market price per share. Get the current market price per share. From that value, divide by the number of shares, get the market price per share, and you shall have finished answering what the examiner wanted. So that part I leave for you to do because it's already 2 minutes past time. and I'm not willing to continue past that time. Thank you guys. Have a good day.
Mwalimu, weka hiyo kasa kwa unlevered income kidogo.